Let's now move on. Macrotech Developers, Abhishek Lodha, the MD and CEO, joins in on the show right now to talk about how their quarter was and what it's likely to be going forward as well. Abhishek, great to have you today on ET Now. And I'm just looking at your numbers, Abhishek. Despite first quarter being seasonally weak, you've actually recorded good pre-sales performance. Do you expect this kind of momentum to sustain or even accelerate perhaps for the rest of the year?
Yes, we believe that Indian housing is at the start of a long-term, up to 15 plus year cycle, and we are only in year 3. And the housing market size in India is only now starting to become what it should be, but there's a long, long way to go in terms of sales growth and volume growth. We think affordability in India is good, and if price rises remain below wage growth, then affordability will keep getting better, and that in turn will unleash even further volume growth. So we do, while of course Q1 and also Q2 are typically the seasonally weaker quarters of the year because of summer vacations, then heavy monsoons in parts of India, in addition to and then we have the Pitru Paksh or the Shraddh period. But in spite of that, Q1 has been very strong in terms of performance for us. We had sales growth of about 17%, and we expect this momentum to sustain for several quarters now.
Right, Abhishek, while the pre-sales have been healthy, revenue recognition has taken a bit of a hit in Q1. Have there been delays in execution or deliveries, and how do you expect things to, stabilize or pan out going ahead?
See, revenue recognition in India has two options. One is the project completion method and the percentage completion method. The second is the percentage completion method. We have so far been following the project completion method, and therefore for the projects which completed in Q1 of 2024, you have to look at starts back by about 3 to 4 years. And as you know, in 2020 and 2021, due to COVID, there were very limited number of new starts. So it is automatically implied that the revenue recognition will be weak on account of the limited number of starts which happened at that point in time. However, that has nothing really to do with the underlying profitability or the business strength. And therefore, we have guided all our stakeholders to look at the metrics of our pre-sales and the embedded EBITDA of our pre-sales while judging the underlying profitability of the business. Our pre-sales were about 3,350 crores, and our embedded EBITDA for those pre-sales was at about 30%, which are both very healthy levels and in line with our guidance at the start of the year. Having said that, we are now for sales done after 1st April 2023, moving towards what is the progressive or percentage of completion methodology of accounting revenue recognition, so that there is a closer linkage between the actual operating performance and our accounting P&L. This procedure takes some time because you have a lag effect of sales done prior to 1st April 23. But all in all, over the next 4 to 8 quarters, you will start seeing our P&L becoming much more reflective of our actual performance compared to what it is right now, due to the accounting challenges that are there with the project completion methodology and the limited number of starts which happened in 2020 and 2021 on account of COVID.
Right. Abhishek, as against the guidance of 14,500 crore rupees pre-sales, you've recorded pre-sales of 3,300 crores. Also, you're expecting a strong performance in the second half versus first half. Given this, would you then be looking to revisit your guidance?
So, when we give our guidance, we of course take into account the seasonality of the business. Q1 performance has been good. However, at this point, we do not see, where we would like to wait before we do any revision of guidance. And we are sticking to our guidance of pre-sales growth of 20%, going from 12,000 crores of pre-sales to about 14,500 crores of pre-sales, with underlying EBITDA margin of about 30%.
So given the growth that you've already outlined, can you tell us how much is going to be led by volume and how much by price realizations? And what's the pricing trend that you expect to see in FY24, given the demand and supply dynamics?
Sure. So we expect of our 20% growth, about 6 to 7% to come from pricing. We like pricing growth to be at reasonable levels. and it should be below the wage growth. As you know, the wage growth for a typical homeowner is about 9 to 10% now. So we like pricing growth to be below wage growth so that there is an increase in affordability and more people can afford and more families can afford to buy a grade A quality home. So we are guiding to price growth of about 6 to 7%. The balance, about 13-14%, will come from volume growth. Out of that volume growth, about 3 to 4% volume growth comes from existing projects, and the balance 9 to 10% comes from new projects. So that's the composition of our sales growth: 6 to 7% from pricing, 3 to 4% volume growth in existing projects, and 9 to 10% volume additions coming from new projects or new launches.
Right, Abhishek, you'd earlier outlined construction expenses, right, of 500 crore rupees for FY24. With the guided operating cash flows of 6,000 crores, you would have 2,500 crore rupees worth of leeway to reduce your debt. Given this, do you think the debt reduction would be much below the targets you've conveyed?
We are looking at operating cash flow generation of about 6,000 crores. And we expect to use about 2,500 to 3,000 crores towards growth opportunities, towards land and new business. And we expect to generate around 2,000 crores or more of surplus for our capital providers, which includes debt reduction as well as dividend payback, dividend payout or equivalent to our shareholders. As we had mentioned earlier, we expect to have our debt between 5 to 6,000 crores by the end of this fiscal, and we stick to that kind of range.
And how is the warehousing and industrial park performance going, and what kind of opportunity do you see there? What kind of top line potential?
So the warehousing platform is a separate independent business, and it would be best for the CEO of that business, Mr. Devendra Rawat, to address those specific points. Macrotech Developers Limited is a 1/3 equity owner in the business, and also is the main operating partner of that business. However, being a standalone business, it would not be prudent for me to comment on its operations. I can give you a broader picture about the fact that the warehousing opportunity in India is very large as the economy becomes more and more formal and our infrastructure improves. The warehouse platform currently has 2 projects where construction is underway, and it expects to add 3 to 4 new projects in the course of this fiscal.
Right. Abhishek, you mentioned that revenue recognition going forward will start to reflect in the company's performance. As the improved price realization also starts reflecting, would margins also then improve from here on?
Yes, we do expect that on a like-to-like basis, margins will move up by about 100 to 200 basis points each year. I think this year, as the contribution from our joint development projects goes closer to its normalized long-term level of 40% of our total pre-sales, we'll see EBITDA levels at about 30%. We may even see similar levels in fiscal 25, but thereafter, we expect to see margins move up by 100 to 200 basis points each year. And as you know, we have very limited D&A costs because we have no real significant fixed assets, and our interest costs are also falling significantly. So therefore, while we expect strong pre-sales growth of 20%, underlying EBITDA margins around the low 30s, but our PAT margins are improving consistently because of the fall in finance costs as well as the overall growth in the business, and therefore our ROEs are going to be approaching 20% on an underlying pro forma P&L basis by the end of this fiscal and then in next fiscal.
Thank you so much, Abhishek, for joining in and sharing with us your outlook.